Right now, there is a massive multi-million-dollar rotation happening in the institutional investment world. For the past year, the artificial intelligence trade has basically been dominated by one single thing: building the foundation. The hardware, the chips. But listen, the smart money is already looking ahead. They're trying to identify the next major growth vector for AI. And to do that, in this explainer, we are going to track the recent portfolio maneuvers of one of the most prominent innovation investors in the entire market to see exactly where that capital is flowing next.
Okay, here's our agenda for today. 1. The AI trade is evolving. 2. ARK's multi-million-dollar pivot. 3. Shopify's compounding AI advantage. 4. Metrics validating the investment. And 5. Navigating broader market volatility. Let's get right to it.
Section 1, the AI trade is evolving, from infrastructure to application.
To really grasp this macroeconomic paradigm shift, we kind of have to contrast where we've been with where we're going. So first, we have hardware AI. These are your semiconductor manufacturers, like NVIDIA and AMD, who are building the literal picks and shovels for the AI gold rush. And if you've been paying attention to the markets, you know they've had an absolutely massive historic run-up. But as competition intensifies, the smart money is starting to rotate towards software AI. This represents the implementers. We're talking about companies that are integrating AI directly into their business operations, into commerce, and into consumer ecosystems to actually monetize its everyday use. It's the big shift from building the AI to actually using the AI.
Section 2, ARK's multi-million-dollar pivot, following the smart money. $15.6 million. That is the sheer scale of the profit-taking on Advanced Micro Devices, or AMD, by Cathie Wood's ARK Invest on May 5th. Now, AMD is a phenomenal semiconductor stock, right? It had surged over 93% this year leading up to this trade. It is the classic hardware AI winner, and yet ARK was aggressively trimming this position along with a few other AI chip names in recent weeks. So the multi-million-dollar question we have to ask is, with all that newly freed up cash, where exactly were they reallocating?
Well, the answer showed up quietly in ARK's daily trade disclosures. $32.6 million. On the very same day they were dumping AMD, ARK loaded up on roughly 255,000 shares of Shopify. And they spread this across 3 of their major ETFs: the ARK Innovation ETF, the Next Generation Internet ETF, and the FinTech Innovation ETF. Listen, this wasn't just some small, speculative bet. This was a high-conviction pivot. They're literally taking chips off the table in the hardware space and pushing their chips, pun intended, into the center of the table on an e-commerce software implementer.
Section 3. Shopify's compounding AI advantage, a category of 1.
So we've got to wonder, why Shopify? What makes this specific platform the target of such a massive capital rotation? Well, it really comes down to what management is calling a compounding AI advantage. Just look at this quote from Shopify president Harley Finkelstein from their recent earnings call. He said, "Shopify has entered the AI era with a clear edge, strong, durable growth, and 2 decades of commerce intelligence." Actually, that last phrase, 2 decades of commerce intelligence, that's the whole shebang right there. Because AI models, they're only as good as the data they are trained on. Shopify isn't just starting from scratch, they're pointing wildly powerful artificial intelligence at 20 years of global proprietary transaction data. That essentially puts them in a category of 1.
And let's look at how this actually plays out in practice. Because Shopify isn't just throwing the word AI around. They are actively operating as an AI infrastructure company for entrepreneurs. Check out these integration points. AI-driven traffic to Shopify stores is up 8 times year over year. Think about that. Internally, AI is now writing more than 50% of Shopify's own code, which creates massive operational efficiencies. Plus, they're pushing really deep into what they call agentic commerce. These are AI assistants that actively help consumers discover and buy products. And strategically, they're even collaborating with Google on the Universal Commerce Protocol. They are not just selling software anymore. They are fundamentally rewiring how global commerce operates using artificial intelligence.
Section 4. Metrics validating the investment, beyond the narrative. Now, as financial advisors and focused learners, we know that a great story just isn't enough, right? We need to ground this AI theory in hard, undeniable data. And $100 billion, that is a massive psychological and financial anchor. Because for the very first time in company history, Shopify achieved over $100 billion in gross merchandise volume, or GMV, in a single first quarter. This proves that their scale is just absolutely staggering and that large merchants are actively flocking to the platform. In fact, to put it in perspective, the number of merchants generating over $100 million in GMV on Shopify has almost doubled in just 2 years. Let's walk through the broader Q1 2026 scorecard because the numbers are incredible. Total revenue came in at $3.17 billion. That's a 34.3% jump year over year. We already talked about that massive $100.74 billion in GMV, up almost 35%. Now, merchant solutions revenue, which is where they really monetize all that volume, that was up a whopping 39% to $2.42 billion. And crucially, they pulled off a 15% free cash flow margin, all while maintaining flat headcount. Think about that for a second. Flat headcount. That is the holy grail for software companies. Hypergrowth combined with strict operational discipline and strong free cash flow. It's basically a pristine earnings report.
Section 5. Navigating broader market volatility, risks, and realities. Now, any objective portfolio analysis requires us to look at the other side of the coin. We've got to navigate the broader market volatility, because if you've glanced at a stock chart recently, you might be scratching your head. We have to address the elephant in the room here. If the Q1 numbers were an absolute blowout, and top institutional investors like ARK are pouring tens of millions of dollars into the stock, why on earth did Shopify's share price tumble more than 15% immediately following the earnings release?
Well, the answer lies in forward guidance and Wall Street's notoriously short-term memory. Analysts at firms like Jefferies and Piper Sandler decided to cut their short-term price targets because Shopify management projected second quarter revenue growth in the high 20s% range. Now, because they've been compounding at over 30% for the last 4 quarters, the year-over-year comparisons are just getting mathematically tougher to beat. Wall Street saw high 20s instead of 30s and basically initiated a short-term sell-off, completely ignoring the massive long-term structural advantages we were just talking about.
But we also have to contextualize this volatility within the broader consumer economy, right? Because Shopify doesn't exist in a vacuum. Major retail staples have been flashing warning signs left and right. Home Depot shares have dipped as consumers slow down large home renovations. Wendy's has seen sales fall as fast food prices start to rival actual sit-down restaurants. General Mills has been losing ground to cheaper private label brands. All 3 of these massive companies recently hit 52-week lows. The American consumer is feeling the strain of economic uncertainty, and that broader retail anxiety inevitably bleeds into e-commerce sentiment, creating temporary headwinds for a stock like Shopify, regardless of its individual technological excellence.
So the crucial point here is understanding the timeline of your investment thesis. On one hand, you have short-term market jitters. You've got analysts worrying about Q2 growth slowing by a couple of percentage points, and macro retail strains spooking day traders. But on the exact opposite hand, you have long-term institutional conviction. ARK Invest absolutely did not care about a temporary 15% dip. In fact, they used it as a buying opportunity to scoop up millions of dollars in shares at a discount. Why? Because they see the structural AI advantage and a platform that is moving over $100 billion a quarter.
Which brings us to the final thought for you to take away today. We've seen the hardware stocks have their moment in the sun, creating the infrastructure of tomorrow. But as the smart money rotates, you've really got to ask yourself, is your portfolio properly positioned for phase 2? Are you prepared for the massive wealth creation that's going to happen as we shift from building artificial intelligence to actually monetizing it through software and global commerce? I'll leave you to evaluate your own holdings with that in mind. Thanks for joining me on this explainer, and keep learning.